Hello, and welcome to CreditSights' LevFin Outlook for 2026 in Europe. I am Luke Miller, Global Editor-in-Chief at LevFin Insights, and I'm pleased to be joined by my distinguished colleagues, Jane Gray, Head of European Research at Covenant Review, Ruth McGavin, European Bureau Chief at LevFin Insights, Mark Chapman, Head of Telecom, Media and Product Strategist at CreditSights, and Shoshana Harrow, Senior Director at Covenant Review. Over the next 30 to 40 minutes, we will discuss the outlook for both the primary and secondary markets. This will include why we are constructive on the primary markets, but let's touch more cautious on secondary, where bifurcation will likely be a key theme. Consequently, we believe that not only is credit selection key this year, as is the likely behavior of company owners, but that there needs to be greater scrutiny on documentation, where the flexibility granted in recent years could lead to more creditor shenanigans, while added flexibility in primary docs granted today may well come back to haunt you in the future. But to kick things off on the brightest of notes, let's focus on the outlook for the loan primary market. And with that, over to you, Ruth.
Thanks very much, Luke. We've had a very constructive start to the year. So typically, January you might begin with a few double B high yield issuers to wake everybody up gently. But this year we've really powered up quickly. We've had some TLB repricings to get started. And more notably, we've had several LBOs getting underway. So we think there's about 5 billion euros of M&A and LBO paper in syndication at the moment. That includes Hologic, which is wrapping up at the moment, TCM, Hillenbrands, and others. Perhaps more notably, there's I think over 7 billion euros of TLB paper mandated and waiting to come to market. I'm not going through the full pipeline, but if you want to see the list, it's on the website, or you're welcome to get in touch and I'll send it to you. On that basis, I think even if some of those deals trickle into the second quarter, which I think a few of them will, even so, we could be on for the busiest quarter for M&A since 2021. So yeah, it's been a strong start. I don't think that necessarily means that M&A is back in full flood. I don't think that's the case. So we've definitely still been seeing secondary buyouts falling away. It's still really difficult for sponsors to meet purchase price multiple expectations, especially for deals that were originally done in 2021. So that part of the market, I think, is still difficult, but we've got quite a lot of corporate carve-outs underway, and arrangers say that they're expecting more on that front. So corporates kind of using the good financing conditions to try to streamline businesses, see what they can spin off, and private equity firms are sort of ready and waiting there. So in terms of the supply of new money, the net supply into the TLB market, we're 2 weeks into 2026, and already we've got 5 billion, so well over half of what came to the market in the whole of the fourth quarter of last year is already in syndication. So thinking about what that means for spreads, there was an expectation towards the end of last year that the inbound supply might mean that new issue spreads would nudge a little bit tighter, that it would be difficult for borrowers to achieve some of those very tight prints that they got in November and December. Now, I'm not sure about that, because seeing some repricings already go through at tight levels, and also seeing where the Hologic deal is expected to price. So the talk is out on that just now at 275 at par for the euro piece. That's very tight. So I'm not sure that we will see a widening at the moment. And looking further forward, arrangers say in general that they don't think, even though the pipeline is good, they don't think there's enough new supply coming to drive any kind of decisive or sustained widening in pricing. Overall, demand is still very, very strong. We've got lots of CLOs chasing paper, and that will increase during the year because we're going to have new managers coming online, armed with equity and ready to go and to try to build their businesses. So, Luke, could I have the next slide, please? So, yeah, thanks. So, I mean, just in terms of the repricings, we had last year about 112 billion euros come to market. It was a very, very dominant part of everything that went on in primary. Now, I sort of struggled to see that matching because, it was just such a strong year. So much got done already. But roughly 63% of the JP Morgan index is bid above par, so there's no doubt that there will be more to come. And we've already got, several deals that have got done. And investors say that wherever they see a lull in the new issue supply, they expect more borrowers to come and ask to reprice. So that sort of gives a picture of supply demand. Jane, do you want to jump in and talk about what impact that might have on the trends around documentation?
Yeah, thank you, Ruth. And yeah, thank you, Luke. So, as Ruth just said, the strength in technicals that we saw last year, especially terms for new money, by and large, really dictated the weakening of covenant provisions that we saw. Covenant Review's composite score for the end of the year was actually the weakest on record since 2017. And I'm just excluding one late 2022 outlier, but it really shows these scores that we saw a normalization of really permissive terms and the continued erosion of many historically protective features that we had in the European loan market. Now, last year, pushback was really limited. It was just some headline features and investor concerns, really in respect to LME susceptibility. Our annual wrap, which is available on the website or if you get in touch, includes a chart of the prevalence of flex of the most permissive terms. Number one being the high watermark provision, then introducing a J-crew blocker, adding a cap to EBITDA adjustments for anticipated cost savings and synergies, and then the fourth being addressing what we call Altice risk. So that's no ratio test, the use of the builder basket for making investments. So relative to 2024, investors really focus their limited ability to amend terms on those four things above, at the cost of a lot less flex in things like pre-notification requirements on transfers and things like asset sale leverage-based step downs. Now, flex last year at early bird stage was much more limited relative to previous years. And that is again illustrative of the market technicals, which have been so strong, and as Ruth has said, will continue to be so strong, even for the largest investors. So in terms of our outlook, we expect to see focused but very limited pushback in new money deals in 2026. Now, in terms of documentation itself, it's certainly been the case of more is less, and that's less protection. Term sheets and SFAs are becoming increasingly longer. Term sheets that we get can be up to 70 pages, and we expect investment decisions to continue to be made at that stage. We would always encourage disclosure of financial calculations at that stage, and that's often lacking in term sheets. That I expect will continue to be the case. Now, in terms of credit agreements themselves, they've become increasingly lengthy, increasingly complex drafting, with more and more and longer permissions, exceptions, and caveats. A full review, which often is very, very late in the day, can often indicate that perceived protections have multiple workarounds. And that is a theme that we will see throughout 2026. I'll give you just a few examples. These workarounds result in an artificial cap on synergy-related adjustments, a high watermark provision that may seem to have been flexed out, but is actually drafted in a different way, but to the same effect, universal reallocation flexibility. And this comment is also relevant to what I've put here, the holy trinity of the CERTA, CHUI, and J-crew blocker. It's a common flex addition. We'll continue to see it as a common flex addition, but it's often narrow in scope, and it's often, as I've mentioned, susceptible to workarounds. So I expect that to be something that we will look to address this year. I will just mention CERTA protection is actually arguably worse when it's added in relative to the traditional, albeit ambiguous, sacred right protections that we have in European loans. And that can be an unintended consequence of the layering in of US concepts. So as I've said, we expect to see more focus on that as we expect to see more European LMEs come in the market. And again, I would invite you to look at our annual wrap on LMEs, which is available upon request or on the website. So something we've also discussed a lot of in 2025, but there's been a persistent trend of sponsors attempting to rig the game in their favor when it comes to possible LMEs. And this is accomplished through the introduction of provisions that ensure that sponsors have control over how an LME is negotiated. And those provisions are put into new debt documents, and that's something that we will also be focusing on and expect to see in 2026. So that's syndicate control, i.e. controlling the makeup of the syndicate group. It's something we've seen a long time in Europe, and it's actually a hallmark of European loans to have quite onerous transfer restrictions. There was an increasing prevalence of that in 2025, increasing normalization of certain restrictions. In terms of outlook for 26, I expect to see more concentration limits. I expect to see a reduction of the threshold on the concentration limits and an increased time for pre-notifications on transfers, which will become, again, more prevalent in the market. In terms of voting control, i.e. a practical means of controlling negotiations, we did, as I've mentioned, see more CERTA-related changes to amendment provisions that really throw out those historic European protections, and we expect that to continue as well. Deemed consent provisions, which arose out of the COVID era, are not limited to A&E only amendments, but to any amendment request. And again, we'll expect to see more of those clearing in the market. We can't have a webinar about doc terms without talking about anti-co-op provisions. They haven't yet cleared in the European market, but we certainly expect them to continue to be attempted, and it's something that we watch for in every single deal. I'll try and go a bit faster because I know I've been talking for quite a long time. Outlook, we may see anti-law firm provisions as we've seen in the States. Another one, so Ruth mentioned, credit selection is going to be really, really important this year. It's always important, but an increase focused on that. And with that, reporting. So reporting deadlines have extended notoriously in Europe. There will be an increased focus on that, and we'll certainly be looking at that, as well as the actual quality and the content of the reporting, something that only gets looked at after the fact and less so in the primary syndication period. So really, I think when I think about 2026 as a whole, understanding the art of the possible is absolutely key. An analysis of risk under the covenants is both multifactorial and deal specific. There are some specific situations that we've flagged, certainly towards the end of the year, where we've seen common misconceptions or standard terms that are underemphasized in understanding covenant risk, whether that's the treatment of off-balance sheet liabilities, recurring fees and the calculation of interest expense, or simply value extraction despite a blocker. So those are the things that we'll be spending time focusing on in 2026. And Luke, I'll pass back to you.
Thank you very much, Jane. Before I turn to high yield outlook, primary outlook, can I just remind there is a Q&A widget for anybody that would like to submit a question. We will try to get through some of those at the end. But yeah, let's turn to high yield primary. And it's a similar picture to loans in that the market ought to be technically underpinned, not by CLOs naturally, but by the wider fixed income market seeking yield as rates have come down and will likely continue to do so a little this year. And that should lead fixed income funds to up allocations towards high yield. And then there was the trend of last year of money seeking a home outside of the US, which has the potential to continue this year. Should, of course, inflows remain robust to strong, then new issue pricing will fall further. That in turn will spur greater issuance. And the expectation is that gross volumes this year will top 100 billion for the third consecutive year. And within this, it will be dominated by refinancings and double Bs. That the market is dominated by double Bs is hardly new. It's been the case for 15 years, as you can see from the chart and the breakout down of the main high yield index. But really, the boom in double Bs took place about 5 years ago, and there's no reason to think that there's going to be a great shift in 2026. This should in turn make high yield attractive due to the improved ratings profile, even if buy-siders are not necessarily being compensated for taking on double B risk over, say, the even more defensive triple B space, but we will speak more to that later. What this year will hopefully bring, though, is further growth in the market. And it's a little hard to see, but at the very end of those lines, you can see that the high yield market has grown for last year, grew for the first time in 3 years. That was broadly evenly split between growth in double Bs and single Bs, and stemmed in part from new money supply and there being fewer credits that exited the market in favor of other forms of debt or sort of cash deleveraging, all of which will likely leave the market imbalanced as there continues to not be enough new money supply to meet demand. That said, there'll still be pockets of new money, and LFI has data, which I haven't put up here, but we do if you want to get in touch, having data showing that of last year's roughly 118 billion of gross supply, about 40% of it was new money. It is, though, hard to see that rising significantly this year. So let's think about new money potential this year in the primary space. And for that, we probably need to go back and take a look at 2025 because we expect some of those trends to continue. Let's start with the negative. Unfortunately, that means there is unlikely to be a large pickup for high yield in LBOs, even if it is off such an historically low base. Last year was particularly weak for high yield financing LBOs. I think there are about 5 such instances. And that is essentially because the lure of the loan market with its flexibility for sponsors remains. And then you've had the rise of private credit offering similar flexibility, but has also hoovered up the space of providing subordinated debt. That means that most LBOs will continue to go down the loan or the private credit route. That said, as a few of us were discussing on desk the other day, the size of the LBO will matter, as in the very large LBOs, there should still be a space for Euro high yield. And that's certainly the case in the sort of small handful of jumbo LBOs that we have on our calendar. But because there have not been that many LBOs, debt-funded dividends have also been on the rise, and there were an eye-catchingly large number last year. To put some numbers on it, we had about 15 in high yield last year, following about 12 in 2024. To put that in context, 2019 through 23 combined hosted only 12. That means we've had more than double in the last 2 years than we did in the preceding 4-5. We expect this trend to continue as private equity and corporate owners look to return value in the absence of being able to make sales. And the good news is that these ought to be, at least in principle, centered on good quality companies with proven deleveraging, both to make them palatable for the buy side, but also for owners that have one eye on an exit and don't want to over-lever assets ahead of any potential IPO or sale further down the road. Corporate M&A also should be seen more frequently, in part as companies look to sell non-core assets to raise cash, but also as they look to expand through bolt-on acquisitions. And there's already been an example of this in the market, not a bolt-on, but we have BetClick funding its acquisition of Tipico. It's already out in the loan market, but has flagged that there will likely be other secured debt, which is usually high yield. All of this activity, though, will be on the periphery, as primary, in our opinion, will once again be dominated by refinancings. If you combine refinancings with general corporate purposes, and the latter is usually a proxy for refinancing at high double Bs, then 2025 was a record for the number of refinancings that took place. This is unsurprising, as many companies on the double B side had delayed their refinancing because they didn't want to refinance out a high coupon debt. into low coupon debt into higher coupon debt. The good news, though, is that refinancing actually bought a notable amount of the new money paper, as many companies sought to refinance other forms of debt other than just bonds into high yield. But we do expect bond-for-bond takeouts to be the cornerstone of the market. And this has already been the case so far this year, where we have 7 companies either having priced or still in market this week, all of which are refinancing debt, and 6 of whom are issuing BB rated bonds. The scene has therefore been set quite clearly for the weeks ahead. Already, it's pretty clear that demand is very good, with book building frequently allowing companies to tighten price talk, and many will be cutting their cost of many will be able to and some of them will be able to cut their cost of capital as new issue yields have tumbled further. To put that in context, the average new issue yield for BBs in Q4, according to LFI, was a little shy of 5%, about 4.85, and that's about 50 basis points tighter than the year prior, and over about 230 basis points tighter than 2 years ago. What instead will be interesting for us to see will be the pace of refis. Bankers commented late last year that 26-27 maturity wall is relatively small at about 50 billion. But in the second half of the year, you should expect the 2028 maturity wall to come into view. And interestingly, the 27s and the 28s are then largely made up of 5 non-call 2 issuance from 2022 and 2023. Back then, new issue yields were noticeably higher than they are now, as I've pointed to. So while the call prices will be elevated historically, as the coupons in 2022 and 2023 were so high, the cost savings that you can lock in now may still make a refinancing economically sensible. And it's not just us that thinks the bond-for-bond trade will dominate. The secondary market is clearly pricing this in too, with billions of paper trading at the yield to call. And with that point, I will pass to you, Mark.
Thanks, Luke. So now we're looking at the market, and you see about 15% of the high yield index is now trading to calls in the 2026 to 2027 timeframe. That's about 58 billion worth of paper, and about 47 billion of that is trading to calls in 2026. And as you can potentially see from the chart below, the average coupons on those bonds that are trading to call are, quite close to 6% for double Bs and not too far off 8% for single Bs. So realistically, a lot of these companies could expect to shave, potentially as much as 200 basis points off their coupons by calling in the next year or two. And so as a result of that, I would expect, at least 30 billion, but potentially as much as 50 billion of paper to be called and replaced, which should help to keep supplies elevated, even despite somewhat more limited near-term maturities, as Luke was just mentioning. They're about a third lower than they were this time last year. So that's a pretty meaningful difference. So given that, there's still an outlook, as Luke says, for, north of 100 billion of total supply, it does beg the question about the documentation trends on the bond side, and we're going to hand over to Shoshana to talk about that.
Thanks very much, Mark. Well, on the covenant side, as Luke explained, refinancings are expected to again be the dominant source of supply this year, with a really heavy volume of bond-to-bond takeouts. And there, I expect we'll continue to see the same kind of what we call covenant creep that we've seen over the last couple of years. So we'll have these incremental increases in flexibility that just contribute to the overall upward trend towards more permissive covenants. Now, of course, there are always exceptions or trickier credits where there's maybe some concern about getting the deal over the line. And in those cases, you may see some covenant tightening. But I would expect for the vast majority of refi deals that we'll see new and bigger baskets, we'll see looser ratio tests, we'll see fewer restrictions on non-guarantor debt, so more scope for priming. In that respect, maybe some more permission to secure debt, whether that dilutes existing holders or primes them on an effectively senior basis. I'm certain we will continue to see more scope for EBITDA add-backs, whether by way of new adjustments or a looser cap or removal of the cap altogether. We see longer look-forward periods or some combination of all of the above. There's usually a tweak or two to calculation flexibility, that I'd expect to see maybe a little bit of further exclusion from ratio calculations of a basket or a particular category of debt. And then last but not least, I'll expect to see a lot of new or looser portability provisions. So on an individual level, the changes normally are more subtle than they are dramatic. It's kind of like watching your children grow. You maybe don't take too much notice as that school blazer goes up a size year on year and their height kind of creeps up. But the overall change becomes apparent when one of those photo memories pops up and you see the stark change from a few years ago. The same holds true on the whole for covenants and high yield. These incremental changes deal by deal as bonds get replaced really add up to meaningfully looser covenants over time. Now, on the new money front, there I would expect the covenants to continue to push boundaries. The technical imbalance that Luke highlighted, which we expect will continue this year, really plays out in issuers' favor. We're hoping for more volume, but I think as long as that imbalance does continue this year, the ball's going to stay in borrowers' courts. These are the deals where we're going to see the wildly oversized capacity and extreme calculation flexibility, like ratios that can exclude all outstanding carve-out debt and overexpansive pick your poison baskets that are sized at 200% and pull in all of your restricted payments capacity. We'll see available amount baskets that give an issuer a second builder, and in many cases build from permitted debt. So you create a really bizarre situation where a company can increase its capacity for value leakage by increasing leverage. I think we'll see no worse options for all of the ratio tests throughout covenant packages, coupled with, again, these really broad exclusions of debt from the ratios themselves, up to the point that under a lot of deals, those tests are almost fictional limiters. You basically just got a free flow of value out of the restricted group and enormous, almost unlimited capacity for debt. And I think, unfortunately, Jane mentioned this as well, we will continue to see what we now call Altice risk, which is big build-up baskets, whether that's from a massive starter amount or perhaps backdating, coupled with no ratio tests or other conditionality if that basket gets used for investments. And then on top of that, I think we'll see some loose amendment provisions that allow more changes than normal with just simple majority consent. So on the whole, in these deals, you're going to see a ton of dry powder for value leakage, for leverage, for collateral dilution, and unfortunately, potentially for an LME down the road. As for pushback, of course, covenant changes have always been a little bit harder to achieve on the bond side. And unfortunately, I don't see any likelihood of a real shift in that regard in 2026. I do think there is the possibility of successful pushback on new or particularly egregious terms based on what we saw last year. Investors were able to push off a new snooze drag provision in a deal in 2025. There was a new tariffs add back that got rejected. There was pushback for a very unusual permission for completely unlimited non-guarantor debt and some other things. So it is possible and certainly worth trying. But unfortunately, I think what we might continue to see is what we think is really an overfocus on some of the more common asks, such as including a J-Crew blocker, whether or not it's A, effectively drafted, or B, particularly meaningful for that credit. We'll see caps on EBITDA that is, as Jane mentioned before, often really cosmetic, because when you have an EBITDA definition that has 10 separate limbs of add backs, capping one is not actually helpful. I call those hide the ball changes, that suggest that there's been a little bit of give and take, but in reality, is so much remaining flexibility that slight scaling back is not overall meaningful. What we are hoping for, and we think is a better approach to take this year, is a really targeted pushback that takes into account the particular credit and the terms of the bond itself. So rather than a sort of one-size-fits-all approach where the standard ask is for, say, J-Crew blocker, taking into account this limited appetite and limited time for change, a really tailored pushback for a particular bond, a particular business. And with that, Mark, I'll turn it back over to you to talk about secondary.
Thanks, Tina. So I guess the key term for the secondary market really going into 2026 is bifurcation. We really have a very interesting dynamic at the moment where on one hand you've got the spread between double Bs and triple Bs is just 1 basis point off the long-term tights, just around 70 bips. But at the same time, the spread between triple Cs and single Bs is, 300 basis points wide of median levels and 800 basis points wide of the tights that it got down to, say in 2022. And so you really have these two sort of extremes. And in that sort of context, you've got to think both about sort of bull market behavior and also bear market behavior. Overall, our strategists have an underweight recommendation on European high yield, based on our expectation that you get below coupon returns for 2026. Base case is for a total return around 3% as coupon income from still fairly decent all-in yield is offset by some degree of spread widening. We're expecting, some softness as macro and competitive pressures start to catch up with over-leveraged credits. At the same time as, very tight spreads for much of the market, as Luke was just saying, the vast majority of it is double Bs. Leave limited scope for price appreciation to offset heavy losses. So naturally, if we think about the kind of core double B part of the market, with such tight spreads and such a small sort of double B, triple B spread differential, you're going to see more bull market activity that you need to be, mindful of. Almost inevitably, we're going to get more LBOs, as Luke and Ruth were just discussing. We have this debate internally about what size they should come in, and while obviously there's some exceptions, like EA Games being the most obvious one. Ultimately, what you would expect in this environment, and I would argue that actually it's a pretty good environment to be doing LBOs if you're a sponsor. We don't actually have line of sight to a huge number of them, and so while we expect to see some more, that's not necessarily a wave that we think is going to really come in size. You will see dividend recaps as well, which you need to be a bit mindful of for your performing credits. Are they going to lever up? This is definitely something that I've seen quite a lot in my space on the telecom side, although certainly in my space, and I would say that this is something that we also observe more generally. It is a risk, but so far we haven't seen dividend recaps be too egregious. These are mostly companies that are levering up, not quite to the levels that we've seen in the past. In telcos, it's more levering up to sort of a 4 to 5.5 times range, as opposed to previously where it might have been a 5 to 6.5 times range. At the same time, as we're seeing some of these sort of later cycle bull market risks cropping up, we also are seeing a little bit more potential for sponsors to pursue slightly more benign exits, particularly IPOs. And so it's not all that bad. And there should be some room to pick up maybe a few outperformance, especially perhaps in the single B space where the spreads are not quite so tight versus double Bs, and there's potentially some positive exit cases there. At the same time as a real bull market for the double Bs and bull market type of context for the double Bs and single Bs space, you've got triple C single B spreads that are way above long-term median levels, which naturally begs the question: is this because spreads are really wide for triple Cs for a good reason, or is it more an indication of pretty good value? Unfortunately, we expect it's a little bit more of the former, though there's probably some pockets of value there. And the core issue is really zombification at the levered end of the market. We've been talking about zombies in European high yield, frankly, before they even started filming The Walking Dead, which I think was in like 2011. So it's been limping on for ages. But fundamentally, the core issue is that you have a lot of companies that were enabled by very low borrowing costs to build up a high degree of leverage on mediocre businesses or those businesses that are on the wrong side of history, and time is starting to catch up a little bit on those. And so while it's not necessarily the case that you'll see a whole wave of defaults, you should expect some defaults and especially some LMEs to pick up. Our strategists are expecting a default rate to be in around the 3 to 3.5% range, which is well above the recent levels that we've seen. And just looking now at issuers trading at distressed levels, we see about 25 to 30 issuers in the high yield market trading at distressed levels at the moment. About a third of those are single Bs, 2/3 are triple Cs. And there's some pretty chunky cap stacks in there, names that I think will be familiar to everyone. But, there's about a third of those names that have more than $1 billion in index debt outstanding. So there's definitely some pretty sizable pitfalls to potentially need to avoid. And thus really avoiding those pitfalls is likely to be what drives your returns in 2026. So expect some more defaults and especially more LMEs as creditors and sponsors cooperate, not to say conspire, to try and keep the music playing a little bit. So just on that, it's a good time to hand back to Ruth to see whether you've seen that same bifurcation in the loan market.
Yeah, thanks, Mark. It's definitely an important theme in the TLB side as well. There's actually always been quite a big gap between where performing deals and where struggling deals are seen in the loan market. That's really just because the CLO market makes up such a big piece of the buyer base. But that split was sort of intensifying through the second half, through the end of last year. We saw it in primary for sure, and we also saw it in secondary. So looking at the JP Morgan index, the percentage of the index that was trading below 80 has been creeping higher. It's now about 6.2%, I think. And that's even while more and more loans are moving above par. So that the market's kind of pulling in two directions. It's definitely going to be a theme for 26, I think. And so even within sort of a difficult sector like chems or building materials or something, I think there'll still be some deals, some borrowers that find support, manage to make their case, manage to go for a sort of near par solution, and others that are sort of seen as untouchable and have a very, very different pathway. One thing to note is that CLOs went into this year with larger cash positions than they had 12 months ago. Managers generally, they want to stay safe, sure, but they also want to do conviction trades where they can. So they want to be able to pick a credit they believe in and buy it, and it will help them build par. And also very usefully, it could help them differentiate themselves against their many, many peers. So they want to be able to do some credit selection on the sort of the far end of the barbell, if you like. But to some extent, their hands are tied by whitelists, the ability to trade in and out, and also by triple C baskets and other CLO constraints. And more kind of gathering strength is this sort of concern about what the LME practice is going to look like in 26 and how that risk is shaping up. So, Shoshana, I'm going to pass back to you because I know you can talk about this better than I can.
Thanks very much, Ruth. Yeah, last year was certainly a banner year for European LMEs. We saw some really aggressive maneuvers from the likes of Altice International, Selecta, Victoria, Flighter, just at the end of the year. And I think across Covenant Review and LevFin Insights and CreditSights, we're all in agreement that we think these things are more likely to continue than to disappear. Just putting my Covenant hat on, of course, there are lots of levers to pull under the docs that are out there in the market today. And, as I say, it's increasingly apparent that owners and sponsors, sometimes in concert with majority holders, sometimes not, are willing to pull them. So we've got this set of documents out there with a lot of scope for LMEs baked in. There is plenty you can do without even needing to amend the docs, as Altice International demonstrated quite ably by shifting 80% of EBITDA out without a single amendment under its existing bond terms. But then if you do need to amend, high yield bonds in particular in Europe are really vulnerable in terms of what you can do with simple majority consent. So when you add all that into this, sort of new market momentum for LMEs, I think there's a real risk of more to come. Now, having said that, the upswing in LMEs has come with an upswing in litigation, and there are a couple of important cases pending. Co-ops, of course, have been in the spotlight here, and they've been challenged on antitrust grounds by investors in Selecta's case, and then on the other side, challenged by the company in Optimum Communications case. It's early days for both of these lawsuits, and of course, there's no certainty as to how they will play out. But there's been some speculation that investors will keep these lawsuits in mind as they structure co-ops in the interim, and in particular that we might see a shift away from some of the more winner-takes-all exclusive types of co-op agreements, such as the one being challenged in Selective's case. So maybe we'll see a move towards more inclusive agreements, perhaps still with tiered economics, but not so exclusive to risk this type of challenge. And then the other interesting claim that has come up in LME litigation this year is a breach of the minority protection principle under English law. So this was raised in the lawsuits challenging both the Selecta and the Hunkemuller LMEs. In both of those circumstances, the company had New York law governed bonds, but an English law governed intercreditor agreement, which is the norm, quite typical for the European leveraged finance market. And the LMEs involved use of the distressed disposal mechanic under the intercreditors. So using a distressed disposal is a pretty neat trick from an LME perspective because it can let you do things with a lower level of consent than you might need under the debt document itself. But the question is now whether a decision on the minority protection principle claims in these two cases could end up constraining the use of that technique in LMEs in the same way that a decision on similar claims in the Senegal back in 2012 essentially ended the use of exit consents for English law governed debt documents. And with that, I think I'll hand it back over to Luke to wrap things up and hopefully turn to a few questions.
Thank you very much, Shoshana. Well, Jane, you'll be pleased to know that the questions on covenants have dominated, therefore proving you right that everybody does really care about covenants, really. But we only have time for one, so apologies to everyone else that asked a question. We will try to respond to you at a later date. But for now, let's stick with the covenant question. And Shoshana, Jane, is the idea of blocking priming transactions through documentation realistic? Thinking of what happened with Flydora.
I'll take that one. That's all right, Luke. Yeah, it's an excellent question. And Flydora, for those who haven't yet read our report, which I'd encourage you to do, actually managed to structure a drop down despite having a whole suite of anti-LMT provisions and much tighter covenants in their bonds that was put in place in the last round of their restructuring. They neatly sidestepped, well, maybe not so neatly, but what they seem to have sidestepped restrictions on using unrestricted subsidiaries by instead structuring the transaction as an asset sale. We've analyzed how they might have been able to subvert all of the protections people thought they had. And so it's a terrific question that you asked. 100% true that there is no foolproof way to block all LMEs and to protect yourselves entirely. I do think Flydora in particular highlighted some of the perils of over vague drafting. They did have a sort of quasi omnibus blocker that basically said no covenant changes for purposes of a liability management transaction. They didn't then define liability management transactions, so leaves room for argument. This purpose qualifier makes it a bit risky. And also tying it to covenant changes meant that if you structure the transaction as they did here without making any changes to the terms of the covenants, then you weren't foul of that provision. We can learn from that and certainly draft, I think, a better and more protective sort of omnibus blocker and some more protective individual blockers. But the question you ask is a terrific one. And the answer is, as long as lawyers exist, no, there's no one foolproof way, I think, to completely lock down a document. Having said that, I think it's nonetheless important to try and keep it as tight as you can, to insist on really thorough drafting, to insist on, even when you've got a good blocker, on requiring supermajority consent to amend it. Is one of the things we often see. It's a terrific blocker that can be changed with simple majority consent. And that really just takes the knees right out from under it. So hopefully that answers your question on that front. Jane, if you have anything to add, please do jump in.
No, that was a great answer. Thank you, Shoshana. I think we will see more omnibus blockers. I mean, I think high yields ahead of loans, just because you've just had way more LMEs because of the English law restrictions that dominate loans. I think we will see more, but I also think we'll see different ways of doing it. There is a huge focus on LMEs in the US and how they're done, CERTA, J.Crew, Chewy. But I think there's lots of ways that you can do an equivalent situation within the confines of the covenants as they stand. And that's something that I would really think is worth focusing on.
Great. Well, thank you very much indeed to my colleagues for their presentations. Everybody listening, please know that you can get in touch with us with any questions, especially all of those if you're worried about the gremlins in your documentation. Jane and Shoshana will be more than happy to take you through them. And Ruth and I love nothing more than talking markets. The recording will go up on YouTube, I believe. So we have the infamy of being YouTube content producers. Yay. And I am sure the recording will also be made available to everybody that registered. As I say, get in touch if you have any questions. Otherwise, have a great day, everybody. Thank you very much indeed.